Something interesting just happened in the precious metals market. Silver jumped 6% in a single trading session. Gold climbed back above $5,000 after touching levels that had a lot of people worried. And analysts are coming out with some of the boldest predictions we've seen in years. But here's what caught my attention more than any single price move. A major industry analyst just went on record saying that silver will outperform gold over the next few years. Not might outperform, will outperform. And the reasoning behind that call tells you something important about where these markets might be headed. So in this video, we're going to break down exactly what's driving this thesis, why silver's setup looks different from gold's right now, what the gold-silver ratio is telling us, and whether the price targets being thrown around, including silver at $300 and gold at $6,000, are realistic or just headline-grabbing hype. And before we go any further, hey, James here. This is Noble Metals. I want to know where you're watching from right now. Drop a comment with your city and what time it is there. I'm always fascinated to see how global this community is. Whether you're catching this in the morning in Tokyo, afternoon in Dubai, evening in Frankfurt, or late night in New York, let me know. This community spans the entire world, and understanding who's watching helps me create better content. Over the past several trading sessions, multiple developments have emerged within the precious metals market that warrant structured evaluation. Gold has maintained strength near elevated levels. Silver volatility has expanded noticeably, and futures contract positioning remains relatively high, approaching key settlement windows. In addition, regional price differences between Western futures markets and Eastern physical exchanges have persisted. While each of these elements can be analyzed independently, their combined presence provides a broader view of current market dynamics. Markets typically reflect underlying positioning before shifts become obvious in headline commentary. When volatility rises while prices hold near significant technical zones, it often indicates that participants are actively adjusting risk exposure. Observing how these components interact over the coming sessions will provide clearer insight into whether the current phase represents temporary fluctuation or the early stage of broader price rebalancing. Silver's increase in implied volatility is a measurable development rather than a subjective interpretation. Volatility tends to expand when uncertainty around short-term direction grows among institutional participants. At the same time, open interest levels remain relatively elevated as contracts approach first notice periods. Under ordinary conditions, contracts are gradually rolled forward without disruption. However, when a higher-than-average concentration remains active close to delivery windows, it draws attention to positioning structure. This does not automatically imply supply constraints, but it highlights tighter timing sensitivity within the futures framework. Elevated volatility combined with concentrated positioning can amplify price movements because hedging adjustments become more immediate and reactive. Regional pricing differences have also remained visible, particularly between Western spot benchmarks and Eastern exchanges such as those operating in Shanghai. When one region trades at a premium for physical metal relative to global benchmarks, it suggests localized demand strength or logistical frictions. Arbitrage mechanisms usually reduce these gaps over time. Persistent premiums, however, can reflect sustained physical interest. If convergence occurs through Western price appreciation rather than Eastern price decline, it indicates that global pricing may be adjusting upward to align with demand realities. Monitoring these spreads provides useful context beyond daily percentage price changes. Gold's ability to remain firm above key psychological price levels contributes to overall market structure. Psychological thresholds often influence algorithmic trading systems and portfolio allocation decisions. When prices consolidate above such levels, instead of reversing sharply, it may signal underlying demand support. Historically, silver tends to exhibit higher relative volatility once gold establishes directional stability. Because silver's market size is smaller, incremental capital flows can produce larger percentage moves. The interaction between gold stability and silver volatility is therefore relevant when assessing potential continuation patterns. Liquidity conditions also play a role in short-term price behavior. Periods of reduced participation due to holidays or global trading pauses can temporarily lower transaction volume. In thinner environments, price swings may appear exaggerated. However, sustained price resilience during reduced liquidity can indicate that selling pressure is limited rather than dominant. When full participation returns, markets often reassess positioning based on updated information. Observing how prices behave once liquidity normalizes provides clearer evidence of genuine directional conviction. Assumptions that contracts will roll smoothly are generally valid in stable environments. Nevertheless, structural shifts tend to reveal themselves gradually through incremental indicators. Rising volatility, elevated open interest, persistent regional premiums, and price stability near support zones form a combined analytical framework. None of these factors independently confirm imbalance. Together, however, they suggest heightened sensitivity within the pricing mechanism. Markets frequently adjust expectations before tangible supply changes occur. Anticipatory hedging can therefore influence price action even in the absence of confirmed physical shortages. Currency perception remains another relevant variable. Precious metals often function as portfolio diversifiers during periods of monetary uncertainty. If macroeconomic conditions reinforce demand for inflation hedges or currency alternatives, gold allocation may remain supported. Silver's dual industrial and monetary characteristics add complexity to its pricing. Industrial demand expectations can stabilize baseline consumption, while investment flows introduce additional volatility. When both components align, price movement can accelerate relative to gold. This dynamic has historically contributed to compression in the gold-silver ratio during certain phases. The mechanics of future settlement are also important. Most contracts resolve financially rather than through physical delivery. However, when a larger share of participants expresses interest in delivery, sourcing requirements increase. Even without shortage conditions, higher delivery demand can reduce available inventory buffers. Smaller buffers increase price sensitivity to incremental buying. In such contexts, volatility becomes more responsive to positioning changes. The present environment underscores the importance of monitoring settlement patterns alongside headline inventory statistics. Market psychology influences trend sustainability. When participants interpret price resilience as confirmation of underlying demand, incremental allocation shifts can occur. Portfolio managers often adjust exposure gradually rather than abruptly. In markets with comparatively limited physical supply relative to global capital pools, even small percentage reallocations can have measurable effects. If sentiment evolves from cautious neutrality toward constructive bias, upward momentum can become self-reinforcing through systematic and discretionary flows. Inventory reporting requires careful interpretation. Public warehouse data provides transparency, yet not all reported metal is necessarily available for immediate delivery. Ownership classifications, leasing structures, and allocation status affect liquidity. Consequently, headline stock levels do not always represent freely tradable supply. When volatility expands despite stable reported inventories, it may reflect nuanced internal positioning rather than outright scarcity. Analysts therefore evaluate both quantity and accessibility when assessing supply conditions. It is important to maintain proportional perspective. Elevated volatility and positioning concentration do not guarantee abrupt disruption. Markets can operate under tension for extended durations before resolution. However, when several indicators align simultaneously, probability distributions shift toward larger potential moves. Timing remains uncertain, but compression phases historically precede directional expansion. Observing data objectively reduces the likelihood of overreaction, while preserving readiness for structural change. If silver begins to outperform while gold maintains stability, broader attention may follow. Media coverage and institutional research typically increase after sustained performance rather than before it. Industrial participants may hedge forward exposure in anticipation of rising input costs. Financial participants may also adjust allocations in response to improving relative strength metrics. These layered responses can gradually amplify momentum without requiring systemic disruption. The upcoming sessions will provide additional clarity regarding contract rolling behavior, regional premium convergence, and volatility persistence. Smooth normalization of open interest would indicate balanced positioning. Continued concentration near delivery windows would warrant closer monitoring. Likewise, narrowing regional spreads through Western price increases would suggest upward alignment. Evaluating these metrics collectively provides a disciplined framework for analysis rather than reliance on isolated data points. In summary, the current precious metals environment reflects a combination of elevated volatility, sustained gold strength, concentrated futures positioning, and regional pricing divergence. None of these conditions independently confirms a structural transition, yet their simultaneous presence increases analytical significance. Whether adjustment occurs gradually through orderly contract, rolling, and spread convergence, or through faster price repricing will depend on how positioning resolves in the near term. Maintaining structured observation and balanced interpretation remains the most effective approach during periods of heightened market sensitivity. I'm not here to build a cult of followers. I'm here to build a community of thinkers. At Noble Metals, I provide the raw data, but I want you to bring the hard questions. We live in an era where debt is sold as wealth and clicks are sold as value. Don't just take my word for it. I encourage you to be a skeptic. Check my sources, challenge the mainstream narrative, and verify every claim I make. Because at the end of the day, a truth you've discovered for yourself is far more valuable than any hype or financial trend. Real gold is rare, but real truth is rarer. Let's find it together. This is Noble Metals. I'll